Welcome back, everyone, to This Explainer. Today, we're taking on a topic that has generated just a massive amount of buzz and, frankly, a lot of confusion. We're talking about the brand new July 2026 Nigeria Revenue Service tax guidelines for virtual assets. If you've been staring at this dense regulatory document wondering how it's going to impact your wallet, well, you're in exactly the right place. Our goal today is to translate these complex rules into clear, actionable steps for the crypto community. All right, let's dive right in. So, what we're looking at here is the definitive mandate from the Nigeria Revenue Service. It's the absolute framework for how virtual assets and crypto transactions are now taxed in Nigeria. Look, I know dealing with the NRS and navigating new tax codes can feel super intimidating, but seriously, don't worry. In this explainer, we're going to slowly and clearly demystify compliance for you. We want to make sure you have the exact knowledge you need to navigate this safely and avoid any of those costly mistakes when tax season rolls around. Here's our roadmap for today. Number 1, the 6 categories of virtual assets. Number 2, the 3 taxes on crypto. 3, taxable versus non-taxable events. 4, understanding applicable tax rates. And finally, number 5, calculating dollar-referenced gains. All right, Section 1, the 6 categories of virtual assets, and exactly how the NRS classifies your crypto. The NRS has basically taken the entire crypto ecosystem and methodically sorted it into 6 distinct buckets. Category 1 is your standard cryptocurrencies. Think Bitcoin, Solana. These attract income tax on gains plus stamp duty. Category 2 covers your stablecoins like USDT and USDC. Same tax treatment there. Category 3 represents security tokens like tokenized equity. Category 4 is for utility tokens, which includes gaming tokens and those DAO votes, attracting income tax on passive income. Category 5 covers NFTs, where the tax treatment actually depends on your economic substance, like are you the creator or an investor. But you really want to pay close attention to Category 6, sovereign currency. This includes the e-Naira, and it is explicitly treated as fiat. That means it has absolutely zero virtual asset tax obligations. Pretty interesting, right? Just a quick pause right here. If you're finding this explainer helpful so far, do us a quick favor and hit that subscribe button and ring the notification bell for more civic education from We and Law. You definitely won't want to miss our future updates. Moving on to Section 2, the 3 taxes on crypto. Let's contrast the 2 biggest ones first, income tax and stamp duty. Income tax is, well, exactly what it sounds like. It targets your actual profits. If you realize a gain when you sell, or if you earn crypto from employment, mining, or staking rewards, you owe income tax. Stamp duty, on the other hand, is a completely different beast. Think of stamp duty as a toll bridge. It applies specifically whenever you convert fiat to a token or a token back to fiat under the 9th schedule. It really doesn't matter if you made a massive profit or took a brutal loss. If you cross that bridge between the traditional banking system and the crypto world, you're paying that stamp duty toll. And the third tax you need to wrap your head around is VAT, or value-added tax, which sits at 7.5%. Now, the absolutely crucial point here is this. The actual transfer of the crypto token itself does not attract VAT. No way. However, the services surrounding it absolutely do. So when your virtual asset service provider, your VASP, charges you a trading fee, or maybe a broker charges a commission or a wallet management fee, that specific service fee will have the 7.5% VAT applied to it. Section 3, taxable versus non-taxable events. Let's kick this off with some good news. Here is your breathe easy list of non-taxable events. First off, simply holding virtual assets. Even if your Bitcoin goes to the moon and you have these massive unrealized gains, it is not taxed until you actually sell. Moving crypto between your own wallets, totally fine, no tax, as long as the beneficial ownership doesn't change. Staking lockups are also completely safe. On top of that, minting an NFT, tokenizing a real-world asset, or taking out a collateralized DeFi loan, none of these trigger a taxable event. You can do all of these freely without stressing about the NRS knocking on your door. But, the tax man always comes eventually. These are the common everyday events that for sure will trigger a tax obligation. Obviously, selling your virtual assets for fiat is taxable, but look closely at that second bullet point, token-to-token swaps. This catches a lot of people out. If you trade Ethereum for Bitcoin, the NRS considers that a taxable disposal of your Ethereum. It's a taxable event. Also, receiving salary or professional fees in crypto, getting those mining, staking, or DeFi rewards as passive income, and yep, even receiving airdrops that have an immediate, realizable, fair market value, all of these are taxable events that you absolutely must report. All right, Section 4, understanding applicable tax rates. The very first magic number you need to commit to memory is 1.5%. This is the stamp duty rate. Whenever you buy crypto with fiat or sell crypto for fiat, a 1.5% duty applies. But here's how it works in practice. Your VASP actually withholds this 1.5% directly from the token units themselves before they're ever credited to your account. Under Section 12, taxpayer and VASP obligations, exchanges are legally required to do this and then remit those exact tokens to a dedicated NR token treasury, which is fully detailed in Section 11 of the guidelines. The second critical number is 10%. This is the withholding tax rate applied to passive income receipts. So the moment those staking rewards, mining rewards, or DeFi yields hit your wallet, boom, subject to a 10% withholding tax. And listen, if the exchange doesn't deduct it for you, Section 12 places the strict legal obligation directly on you, the taxpayer, to account for this in your self-assessment. You can't ignore it. Okay, ready to do some math. We're about to get into the most mathematically intense, but honestly, the most important part of these new guidelines. So before we crunch the numbers, take a quick mental breather, hit that subscribe button for We in Law, and let's get into it. Section 5. Calculating dollar-referenced gains. To figure out your taxable gain for Category 1 assets, the NRS requires a very specific 5-step formula. Step 1. Determine your dollar cost base. That's the USD price at the exact time you acquired the asset. Step 2. Figure out your dollar disposal proceeds, which is the USD price when you sell it. Step 3 is just simple subtraction. Proceeds minus cost base gives you your actual dollar gain or loss. Step 4 is where we convert back to local currency. You take that dollar gain and multiply it by the official Central Bank of Nigeria NAFEM exchange rate on your exact disposal date to get your Naira taxable gain. And finally, Step 5, remember that your VASP will withhold 1% on your gross disposal proceeds at the source as an advanced tax deduction. Now listen carefully, because if you take literally nothing else away from this entire explainer, let it be this. This is the absolute golden rule of the July 2026 guidelines. By forcing you to calculate the gain in US dollars first, the NRS is ensuring that only your real dollar gain is taxable. If the Naira simply depreciates against the dollar while you're holding the crypto, that artificial Naira inflation is entirely excluded from your taxable income. Seriously, this is a massive, incredibly fair protection for Nigerian crypto investors. It's huge. Let's look at how this plays out with a real-world example straight from the NRS illustrations. Imagine you acquire some Bitcoin for exactly 1 million Naira. At that time, let's say the exchange rate is 1,000 Naira to the dollar. That gives you a dollar cost space of $1,000. Easy enough. Later on, you sell that Bitcoin for 1.97 million Naira. But notice, the exchange rate has now weakened to 1,500 Naira to the dollar. So your dollar proceeds are $1,313.33. That means your actual dollar gain is only $313.33. To find your final taxable Naira gain, you just multiply that $313 by the new 1,500 exchange rate, which equals 470,000 Naira. Just think about that for a second. On paper, it looked like you made a 970,000 Naira profit, right? But because of this dollar-referenced rule, you were only taxed on 470,000 Naira. The other 500,000 was just currency depreciation, and the NRS does not tax you on it. Which brings us to our final and maybe most important question for you today. Are your current crypto records detailed enough to accurately calculate your exact dollar cost base? As we've seen, proving the USD value of your assets at the exact moment of acquisition and disposal is absolutely the key to lowering your Naira tax burden. If your spreadsheets are a mess, you're going to risk overpaying. And even worse, under Section 13, non-compliance carries some pretty severe financial penalties. Now, if you do happen to get audited, Sections 14 and 15 do allow for administrative reviews and formal inquiries, but you are going to need bulletproof records to defend yourself. So it's really time to get your financial data organized, folks. Thank you so much for joining me for this explainer. Stay compliant, keep your records tight, and we'll see you next time.